Most people put money into the stock market before they understand what they are actually putting money into. Not what stocks are in theory, what the market actually is, how it actually behaves, and why the version most people have in their heads before they invest their first dollar is the version that costs them the most money. The stock market is not a machine that turns money into more money automatically. It is a marketplace where ownership in companies changes hands every day between buyers and sellers, and the price at which those exchanges happen reflects nothing more than what buyers are currently willing to pay and what sellers are currently willing to accept. That price has no permanent relationship to the actual value of the company. It reflects sentiment, expectations, and emotion as much as it reflects revenue, profit, or growth. This distinction matters because most new investors confuse price with value. And that confusion is the root cause of the majority of beginner losses. The first thing nobody explains: the stock market does not go up consistently. It goes up over long periods with significant downturns along the way, and the downturns feel catastrophic to anyone who invested recently and does not understand the historical pattern. Since 1950, the S&P 500, the index tracking the 500 largest publicly traded companies in the United States, has reached all-time highs on approximately 7% of all trading days. On roughly a third of those occasions, the market never traded lower after the high was set. Investors who waited for a pullback before buying after an all-time high never got their entry point and missed the continued gains that followed. In any given year, the market has a roughly 70% chance of ending higher than it started. Hold for 5 years, and that probability rises to 80%. Hold for 20 years, and historical data shows a 100% success rate. No 20-year period in the history of the S&P 500 has produced a negative return when dividends are reinvested. The second thing nobody explains: most individual stocks fail to deliver meaningful long-term returns. The broad market index goes up, but the gains are driven by a very small number of winners. JP Morgan's research found that between 1980 and 2020, more than 40% of stocks in the Russell 3000 index, which covers most of the US market, suffered losses of 70% or more, from which they never recovered. Fewer than 4% of stocks account for all of the net profits generated by the entire US stock market over long periods. This is why picking individual stocks as a beginner is statistically identical to gambling. Not because stocks are inherently risky, but because identifying the 4% of stocks that generate the market's gains in advance is something professional fund managers with teams of analysts and decades of experience consistently fail to do. Spiva research confirms that 89% of actively managed funds underperformed the S&P 500 index over the last 15 years. If professionals with every advantage available cannot beat the index consistently, a new investor relying on a tip from a social media account has no realistic chance of doing so. The third thing nobody explains: investment fees are a silent and devastating long-term cost. A $100,000 portfolio over 20 years paying a 1% annual fee ends up with nearly $30,000 less than the same portfolio paying 0.25% in fees, according to SEC data. That is not a small difference. It is a house deposit lost to a fee that felt negligible on a monthly statement. Index funds from Vanguard, Fidelity, and Charles Schwab carry expense ratios as low as 0.03% annually, meaning the fee on a $10,000 investment is $3 per year. Actively managed funds typically charge between 0.5% and 1.5% annually. The return difference between these funds, net of fees, consistently favors the low-cost index fund over any period longer than a decade. The fourth thing nobody explains: checking portfolio performance frequently destroys returns. A 2025 behavioral finance study found that investors who check their portfolio daily are 5 times more likely to sell during a market downturn than those who check quarterly. Selling during a downturn locks in a loss that would have recovered over time. and the investor who sold then has to decide when to get back in, which adds a second timing decision on top of the first. Both decisions have to be correct for the strategy to work. Both decisions are made under emotional pressure. Statistically, they are not. The market dropping 2% on a Tuesday looks catastrophic when it fills the entire screen of a portfolio tracker. The same 2% drop is invisible on a chart showing 5 years of returns. The data is identical. The emotional response is completely different. That emotional response, the one triggered by daily checking, is one of the most expensive financial behaviors documented in academic research on investor behavior. The fifth thing nobody explains. Investing before building an emergency fund is one of the most common structural mistakes in personal finance. An emergency fund held in a high-yield savings account acts as the buffer that prevents forced selling during a market downturn. A person with 3 to 6 months of expenses in liquid savings who loses their job during a market downturn can wait for the recovery. A person with no emergency fund who loses their job during a market downturn has to sell investments at depressed prices to cover living expenses, converting a paper loss into a permanent realized loss at the worst possible moment. The emergency fund is not a conservative substitute for investing. It is the structural prerequisite that makes investing survivable through the downturns that will inevitably occur. The sixth thing nobody explains. The time in the market beats timing the market, not as a motivational phrase, but as a documented statistical reality. Investors who attempted to time the market by moving to cash during volatile periods and re-entering later consistently underperformed investors who simply stayed invested. The reason is mathematical. The best trading days and the worst trading days cluster together. Missing the 10 best trading days in any decade by sitting in cash during volatile stretches reduces long-term returns dramatically. A 2026 mid-year analysis from Fidelity confirmed that investors who stayed invested through the turbulence of 2026, including geopolitical disruptions and oil market volatility, generally outperformed those who sat out of the market during the uncertainty. The framework that the data supports across every study and every time period analyzed is consistent and simple. Build an emergency fund first. Invest in low-cost, broadly diversified index funds. Automate contributions on a fixed schedule, regardless of what the market is doing. Do not check the portfolio more than monthly. Do not sell during downturns. Increase contributions every time income increases. None of these steps require predicting the market. None require picking winning stocks. None require following financial news. They require patience and the ability to leave money alone for years at a time, which is simultaneously the simplest and hardest thing most investors are ever asked to do. The market rewards the investor who understands what they are doing and why. It punishes the investor who follows tips, checks daily, sells during drops, and confuses short-term price movement with long-term value. Drop a comment with the question about investing that nobody has given a straight answer to. The next video covers the specific accounts, platforms, and fund choices that make starting an investment portfolio as simple as possible in 2026.